Sand through the hourglass.
This is our monthly rate rise. Up 0.25% to 3.6%, the highest rate in a decade.
If you've got the average mortgage size of $500,000, you're going to have another $78 to have to find this month.
The RBA's record run of rate rises leaving the average mortgagee nearly $1,000 a month worse off than in May last year. That's a 42% increase to repayments.
So a number of households are really starting to feel the squeeze. Their interest repayments have gone up a lot, but their incomes haven't gone up as quickly, and today's interest rate hike clearly squeezes that budget even more.
The silver lining, we're still well short of the record high rate of 17.5% set back in 1990. But rates alone don't tell the full story. The average annual wage in 1990 was $27,000 and the average mortgage in Sydney was $117,000. Repayments cost 74% of the monthly wage. Now, the average annual wage is closer to $100,000, but the average mortgage has soared to nearly $1 million. Repayments now cost 67% of the monthly wage.
Interest rates as a share of disposable income are actually still quite low. However, because households have bigger mortgages, because house prices are higher, it hurts quicker. It doesn't take as much in terms of cash rate hikes before people really start feeling it.
And for dangerously stretched homeowners, falling prices are the icing on a cursed cake.
Even at the moment, 2.5% of loans are underwater versus the value of houses.
So negative equity.
Negative equity.
So how much more will households be able to endure? Well, thankfully, Shane Oliver is happy to explain this to us. Shane, how different is this current moment compared to, say, the early 90s?
Well, it's different in the sense that household debt levels are about 3 times what they were in the early 1990s or the late 1980s. But the main similarity, of course, is that the Reserve Bank has been fairly aggressively raising interest rates. Back then, they did keep going, and ultimately we had the recession we had to have, as Paul Keating put it, in the early 1990s. You had these long lags. It took a while for interest rates to really slow the economy. This time around, we're probably seeing the same thing.
What scares me about this, Shane, is there are so many people experiencing so much pain with interest rates at this level. But I've got a graph here that shows a really horrible truth, and that is the interest rates we're talking about right at the end of that graph are actually pretty low by historic standards. And if so many people feel so much pain when they're this low, we've got a real problem, don't we?
Look, it's a serious problem. The reason people have been able to take on all that debt is because interest rates have been so low. So if you do a comparison to 30 years ago, the ratio of household debt in Australia to people's incomes is 3 times what it was, say, in 1989. Now, it's ultimately unsustainable. You can't keep lowering interest rates, enabling people to borrow more and more money. At some point in time, the music stops and there's a problem in the property market. If we're now moving into a world of somewhat higher interest rates, then we won't be able to continue pumping up property prices, taking on more debt in the process.
And not even high interest rates, like normal interest rates. That's what scares me. So if what you're saying is right, that this is unsustainable, is there any way through this that doesn't just cause a lot of pain? Like, have we created a housing bubble that can only be fixed by an apocalypse?
Look, I hope not. There's certainly a risk there. And of course, you don't know the point at which you go beyond where you go off the cliff. But there's always this risk here that they make a mistake. They ignore the fact that monetary policy impacts the economy with a lag. They take last year's economic strength as being real, when it was probably a big chunk of it was due to the reopening boost, the so-called revenge spending and revenge travel, and they end up over-tightening. So that's what the Reserve Bank Governor refers to as the narrow path between getting inflation down, but at the same time trying to avoid a recession.
Shane, mortgage holders feel like they're being screwed. Is there someone else to pick on, like corporate profits, for example?
Well, in an ideal world, the pain should be spread around more, and that would involve the government implementing measures like raising taxes on companies or on all of us, or maybe raising the GST or doing something which spreads the pain around rather than picking on those with a mortgage. That is the way things used to be done. We used to rely on government to control inflation back in the 1970s and 80s, and of course it didn't work. The problem for governments is they don't like raising taxes because that causes political pain for them, whereas it's obviously easier for the Reserve Bank to inflict that pain because it's not subject to political wins and won't be kicked out by voters. It's easier for the Reserve Bank to inflict that pain because it's not subject to political wins and won't be kicked out by voters.
Shane, you're wearing a very jaunty tie there. Can you give us some good news? When are we going to see the end of these rate rises? Will we see them go down next year, later this year? Give us some good news as homeowners.
Well, I guess as an economist, I often call it the dismal science. So to make myself happy, I like to wear a bright tie. But it looks like the Reserve Bank is becoming less concerned about inflation, more convinced that the economy is cooling down, and its signalling regarding future interest rate increases is not as aggressive as it was a month ago. And it's even opened the possibility of a pause. My view is that we're probably pretty close to the peak, and we may have already seen it. But I think the evidence is overwhelming that the economy is slowing down, that interest rate hikes are really starting to bite. And when the economy slows down, that will take pressure off inflation.
All right, Shane, thanks so much for your time.
My pleasure. Thank you.